Hi, today we are looking at CuriosityStream, which came public via a SPAC previously known as Software Acquisition Group. Now it's just CuriosityStream because the SPAC is closed and it trades under the ticker CURI. So CURI stock, and that's for CuriosityStream. The stock is up about 100% since the SPAC deal. And in fairness, so this isn't all just hype. It is a very fast-growing company. So you got the fundamentals as well as the valuation driving that share price. Management is projecting a blistering 10x growth over the next few years, and they might just do it, which is super interesting. CuriosityStream has a very interesting business model as they're looking to become the niche player for factual streaming content. It's sort of like a Discovery Channel, except a streaming first Discovery Channel. And oh wait, that's exactly what they are, because the founder of Discovery has since moved on and is now the founder of CuriosityStream, and sort of taking it from this, hey, streaming is now this next revolution in TV. How do we make sure that streaming, a global platform for factual content, can be rolled out? And so that's what you're seeing with CuriosityStream, founder, significant investor, and sort of builder of both Discovery and CuriosityStream. So what's the stock's potential? What's the potential for CuriosityStream in the years ahead? It's gone up quite a bit, so you got to call that out. But based on their growth potential, and keep in mind, management is penciling out 10x growth, I do pencil out that this could be up over 100% over the next few years, because you do have these give and takes of valuation and fundamentals. But I'll go into all of this, in much more detail as you watch this video. This is sort of the highlights of CuriosityStream. This video goes out to Samad, who is an Unrivaled Investing Journey subscriber, and about that, a quick 10-second plug, if you will. My name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you enjoy learning about potential multi-baggers, make sure you subscribe. If you're already a subscriber, I do appreciate that thumbs up. Help spread the proliferation of this video. And if you want to learn about my personal journey, what am I buying, what am I selling, what are the potential multi-baggers that I'm finding, go to unrivaledinvesting.com, click on Journey. Now let's do that deep dive into CuriosityStream. So what is CuriosityStream? Here's the mission statement. CuriosityStream was founded to satisfy humanity's enduring curiosity about our world with premium factual content that informs, enchants, and inspires. I.e., the main thing to focus on is premium factual content. This isn't supposed to be junk food for the brain. This is supposed to be something where you actually learn a little something right before bed or when you're tuning out. So what's their value proposition? Well, it's a very low price, $2.99 a month or $20 a year for getting this core segment of factual content. You have this whole factual library, and we'll get into that in a second. And you can see how TV has sort of developed over time. You had the first revolution, which was broadcast TV, whereas the major networks like ABC or NBC was the pioneer. And you have these four content categories, and like movies and scripted series, factual, general TV and entertainment, and sports. And now you're sort of seeing how that evolves. Well, then the next revolution was cable, and you see how this sort of bifurcated and split up. And now HBO becomes the dominant movie player, and then the factual was Discovery, and then you have all these sort of general entertainment. And then you move on to the third revolution, which really started in the last few years, where Netflix is the pioneer. It's a streaming revolution, on-demand streaming, and Netflix is for movies and scripted series, and then CuriosityStream is hoping to fill that void of factual content that's on demand, a streaming first platform. And so that's super interesting setup to see how this has evolved over time. But what's actually in their library? Well, you see it generally has these sort of buckets, whether or not it's science, history, technology, nature, society, lifestyle. You're trying to learn something at the end of the day. You're trying to watch something and you take something away from, wow, I didn't know that's how the world worked. Oh, I didn't know that you've got all this stuff going on. So it's pretty broad based, and it's pretty much for people that don't just want to watch junk food for their brain. They want to actually learn something. They want their meat, potatoes, vegetables, their fruits. They want a healthy diet of what's going into their brain, and that's sort of what the appeal is here with this sort of factual content. The question is there a diet? Is there really that much demand for the healthy food TV versus the the junk food TV. And that's their point of like, look, David Attenborough's Planet Earth 2 becomes most watched nature show, 40.9% audience share for Planet Earth 2. They say Planet Earth 2 more popular than X Factor with young viewers. So they're saying like some particular products, some things that are produced that teach people about the Earth, or that has some sort of naturey feel, or that that covers one of these things, like, oh, King Tutankhamun's like, oh man, this is pretty interesting. He's got this really cool pyramid, and you got hey, there's artificial intelligence, and how's that developing? So there's definitely a lot here that gets people excited. That like I'd personally want to veg out to some of these things. I haven't used CuriosityStream yet, but maybe I will soon. I generally don't have time to watch TV. I'm too busy making videos for you. So, so what's the actual content, and how big can this niche be? And so here's what management has to say, the founder. So how many people are interested in factual content? Over the last 3 decades, I've learned that the audience for factual content is enormous and equates to about 40% of all television viewers. All people are curious to some degree. It is what defines us as humans. I think that personally really resonates as true. I personally I like to try to go to a place I've never been to each week, and if I can't do that, each month at the very least, just go see a different part of the world. It might be just a park somewhere that you just haven't seen before. It opens your eyes a bit. So, however, for about 60% of television viewers, that curiosity runs a bit shallow. It appears that some people are mostly curious about what the Kardashians are up to this weekend. However, with my exposure to TV ratings data for over 35 years, I absolutely know that the world is 40% full of deeply curious people who delight in learning something new. That is a huge number of people worldwide for whom we have targeted our CuriosityStream service. So that's super interesting. Like, if you're able to take an on-demand streaming solution, and if your thesis is that everyone's going to have the internet worldwide, and 40% of the people worldwide are going to be interested in sort of vegging out to factual content, this could be a super interesting play at a presumably very reasonable price of like $2.99 a month. So, and that's sort of the starting rate. If you want to get the 4K, you're going to have to pay up a little bit. So here's some more on what he has to say. This is John Hendricks, the founder, and sort of penciling out this 40% and how to think about that potential over time. So I've always focused like a laser on the addressable universe for a media service and how to aggressively penetrate that universe. In the mid-1980s, when I launched Discovery Channel, so once again, this is the founder of Discovery, a multi-billion-dollar company. He did an exceptional job building that out. There were about 40 million cable households in the U.S. At that time, it would have been able to project that one day cable would serve over 500 million global households as it does today. But as impressive as the growth of cable has been worldwide, its growth in current distribution pales in comparison to the 2 billion plus global consumers who can now stream video. I believe CuriosityStream can become a must-have service that appeals the 40% of the world population who are deeply curious. If we fulfill this long-term mission, we will have a great future with stunning economics. Thank you all so much for listening. So what he's saying is, look, this is just a huge opportunity. More and more people with the internet, 40% of which are, interested in factual content and would like to watch it in the form of entertainment where, you're learning something at an affordable price. Huge potential market. But let's keep going into this. So, who's actually driving this? Who's saying this? Once again, this is John Hendricks. He's the former chairman and founder of Discovery Communications. He built this huge company, literally from nothing to, tens of billions of dollars of value, 2.5 billion cumulative subscribers since 1985. So he knows how to get it done. He worked with the current he effectively brought in the current president and CEO for CuriosityStream. They both work together at Discovery. So this is a team that knows how to make hits. This is a team that knows how to deliver. So when I see this, it increases the odds that management is going to be able to deliver even on their exceptional forecasts. And key element here, John Hendricks will still own about 30-40% of the company after the deal closes, maybe even a little more than that. And so the founder and owner operated company, that just makes me even more excited about seeing this deal. But I want to learn more about the company. I want to learn more about, the economics and how this business works. And so what's the business model as we look at it? And you see there's actually several different business lines, and you see they all pencil out, and they're saying by 2025, what's the potential opportunity size? And they're all roughly the same, give or take a little. So one is like the direct and partner direct subscriptions, where they're saying, look, it's direct to consumer subscribers and subscribers via digital providers like Prime Video, Roku channels, etc. 90% purchasing annual plans accessible by anyone with a broadband connection in over 170 countries. So this is like a global potential, paying a few bucks a month or locking in on an annual plan. They're saying 70 million plus. Maybe it's closer to 100 million in revenue potential over the next few years, but that's not all their revenue. You've got these other sources like bundled multi-video player platform or distributors where they're offered in pay TV packages by wireless providers, cable operators, and direct-to-home providers via multi-year agreements. So let's say you're DirecTV and you want to round out your package for what people can watch. They will pay a fee to CuriosityStream to be like, hey, we need a factual content provider that sort of fits that niche. Will you be the one? We're going to pay for you. And, we create this sort of long-term agreement where for each new sub that DirecTV signs up, those economics are shared with you on a per sub basis, or it could be a fixed fee basis. And the reality is this is a global rollout. This is because factual content, you just change the languages. You can easily roll it out, to around the world. People all over the world are interested in a lot of these different, curiosities. So you have that. You have corporate educational partnerships where multi-year fixed and escalating agreements with associations, colleges, universities, and educational ministries, where it's like, hey, maybe they want to make a video, or they, you work with them to cover a subject, and or they're just interested in having it for their employees. Let's say it's like a gift, a perk for your employees. So then you have sponsorship or advertising where they're putting in traditional, spots and dots, 30-second, 60-second clips on linear networks that can be part of this, bundled plans that they're being part of. Integrated multi-platform digital brand partnerships where, you're getting these major blue chip brands that are putting their ads on the 30-second TV ad spots, on their linear TV channel that goes with these plans. But first, it's a streaming first company. Don't be mistaken about that. And then program sales, where you could sort of take some of their stale content and either license it or sell it in blocks to some of the other TV distributors, the pay TV packages. And you could also pre-sale original content where it's sort of saying, hey, here's stuff that we're looking at doing. Would you be interested in financing this? And then, we'll share it with you after the fact. So that does decrease the risk of producing some of these things. So it is a super interesting setup. By and large, creating factual content, it's not like, you're creating the next Avengers movie where it's this huge budget production and, you really need to drive global demand to get it. It's more of an optionality business where you can spend a lot less, and if you're able to capture, lightning in a bottle, then you can get global demand that's still interested. So low cost and still this huge upside potential. So it definitely has some excitement factor to it, in terms of that potential, in terms of, hey, you could spend a couple $100,000 and then people are like, whoa, I definitely want to watch that. So currently about 40% of their revenue is from subscriptions, while about 50% are from licensing fees. It's about 50-50. It depends on the quarter. By and large, it's around 50-50, 50% subscriptions, 50% licensing fees. That might change a little bit over time, but you could see, they're not penciling out one dominating the other. They're like, hey, the bundled fees, the fixed fees and licensing fees that we're getting from various different pay TV packages from these various different TV providers, that's going to be 25-35% of revenue. The same thing for subscriptions, same thing for educational, corporate and educational sponsorship. So it's not like one piece is going to be driving this bus entirely. And you can sort of see how this ecosystem works, which is, you work with many, many, many different producers to create or license this factual content. Then it's distributed, over here, and this is the direct partners like Prime Video, Comcast, YouTube TV, and then you can't even read it, but there's just, dozens of worldwide bundled distributors that you could be working with, and then they're tapping into these global consumers, in terms of reaching out to the 2 billion people that John Hendricks was talking about, of how this is just such a huge opportunity, of people going online, ultimately being interested in factual streaming content. And so what is actually the content? And if you flip through it, I mean, you can go to curiositystream.com and you could see, what's in their library right now. They have over, 3,000 nonfiction episodes, 1,000 original commissioned co-produced documentaries or short form, mid form, and long form duration. It's stuff like The Secret World of Lego or The Truth About Killer Dinosaurs or Ocean Mysteries Season 4 and what actually happened at Woodstock, capturing Woodstock. Maybe you see some saucy pictures. Then there's Alaska Extreme. So it's taking these things, you punch it up a little bit, and maybe you have cocktail hour and you enjoy watching this thing at the end of the day. So that's and they're working with various different content partners, BBC in the UK, NHK in Japan. They're working with these, it's not like these huge for-profit studios. Maybe it's like something that's in a given country that's looking to create things where you can learn about a given country. Hey, you want to learn about Austria, you want to learn about the UK, hey, we're going to work with BBC and, we'll cover some of those things. So, it's interesting. Our programs have received 3 Emmy nominations, including an Emmy Award win for Stephen Hawking's Favorite Places. Other than historical footage or classic documentaries, every title on our platform is available on demand in a high definition or 4K quality. And so, it's this appeal of, featured scientists, experts, and celebrities such as Stephen Hawking, Sir David Attenborough, and Sigourney Weaver. Sigourney Weaver isn't a scientist unless you're counting Alien as a movie. So, who owns the content? And this is sort of the challenge or the risk in the business right now, is that about a little under 70% of their titles are subject to licenses. So effectively they're licensing out the content. And all of this content expires, is up for renewal over the next 2 years, 2021, 2022. And that's a tricky position to be in, because at the end of the day, you're constantly having to relicense content. If the folks that are licensing the content out to you see that you're successful, they're going to charge you more. They're going to sort of hold you over the barrel. And this is honestly the position that Netflix was in when they sort of started out, where they didn't own a lot of original content. What sort of helped Netflix launch was the fact that they were able to get a really, really juicy deal from Stars, where they were paying something like $25 million a year for this huge library of content, because people didn't really think at that time streaming would launch. And so you had this potential of like, hey, we're not paying that much for content, and now we're growing real fast. And so this is the challenge, is that people know that streaming is out there. So so what did Netflix do? Well, Netflix was like, we're going to scramble, we're going to borrow a ton of money, we're going to have this huge cash burn, because we want to create our own library. We want to own that tail of content. We want to own it years and years. And so they've changed. They've disrupted the industry. In the past, the people that made content, they would bank on the fact that they would get the residuals in years after. That whole business model is changing, because you have players like this that are like, well, wait a second, do I want to constantly have to license this out where people are getting paid the residuals, or do I want to own the content and have to sort of pay that up front? So I sort of suspect you will see that with them, where their cash burn and their marketing spend is going to be higher, because they're going to need to acquire this content, because you don't want to perpetually be over the barrel in terms of licensing it from someone else. But maybe it's also a slightly different business model, because you're working with like the BBCs of the world versus a big Disney type movies, where ultimately Disney competes directly with you. As you look at it, as of the third quarter 2020, the average churn was approximately 3%. This is from their prospectus. That implies about 70% annual retention for their subscribers. And this is the tricky part, because this is the challenge, the sort of a fine thread that they have to do, because you have growth expectations. You're expecting to grow 10x over several years. And in order to grow 10x, you're going to need to get content that would support that number of subscribers. So you need to constantly invest and spend more on your content. And then that creates the challenge of like, well, wait a second. Let's say we budget out and say, hey, we want to license out all this new content. Let's beef up our library so that way we can get more subscribers in the months and years ahead. But if you start licensing all this out, and let's say there's a financial crisis or something happens, and let's say subscriber count doesn't grow like you expect, then you start getting into a really tricky position because you've licensed out all this content that you're going to be paying, presumably at a fixed fee, and you got to make it up with subscribers that may not be showing up. So that is the risk with this business model, is that it's sort of like you have to grow fast or die. You have to do this. You have to grow. You have to make that investment in growing subscribers. And so that's why they're not going to be profitable, at least for the next few months, next year or so, until the end of 2022 is what they've penciled out. But it's just something to think about. That's the challenge with these businesses, is sort of matching their growth as well as with the library of content. You constantly, if you don't invest enough in the library, you're not going to get the growth. But if you don't get the growth, then you're not going to be able to pay for the library. So it's sort of a tricky challenge that's very fine threaded in terms of how do you make sure you actually deliver without blowing up your balance sheet. But it is a beautiful business model, and they talk about here where they go, the bundled distribution business with cable operators, direct broadcast satellite providers, and wireless distributors requires real work. It's not easy to break into as it is a long sales cycle, but we have a unique proposition as one of the very few pure play factual media companies in the world. And once you break in, it's a great model in light of the guaranteed recurring revenue, i.e. once you've established this relationship with these TV baskets, you can sort of get this recurring revenue, these recurring, you have a TV producer or a TV bundle around the world, and they're like, hey, we need factual content, and you are that pure play, factual media company. You can get that recurring revenue because you're their channel that they put into their bundle. We're sowing a lot of seeds with distributors internationally, and as these distributors look to shave costs with bloated legacy network agreements, we are the perfect replacement solution. That is a key phrase that they said that's worth thinking about. Let it sort of sit in your head, where they're sort of saying, look, there are other players out there that are more heavily dependent on these bundled agreements that might cost more. These legacy network agreements, if these folks are looking to shave costs, i.e. we are cheaper, more affordable than some of these legacy agreements. That is, like, when I read that, I was like, this is super interesting for them to frame it like that. And maybe it's because they're a streaming first business that they have all these different revenue drivers, like a direct-to-consumer subscriber business, that can help them have a lower fee rate than, let's say, the legacy providers like a Discovery Channel and the fees that they need to have in order to sort of keep up their margins or run their business. So this is very interesting. We typically receive a fixed annual fee, or in some cases a fee per subscriber, in exchange for conveying a broad scope of rights, which include a 24/7 linear channel, a big video on demand collection. Mobile rights are out-of-home rights, and pricing and packaging flexibility. All rights that legacy networks like to parse, which drives distributors crazy. These agreements are typically 3 to 4 years in duration. We currently have about 20 bundled distribution partners in 83 countries in 5 languages. We expect to double the size of our roster in 2021, as we are currently engaged in conversations with well over 100 bundled distributors. In the last year, our bundled paying subs grew by over 10x. While we won't grow at a 10x rate going forward, we do see a clear path to 100 million paying subscribers in the next few years. And that's the key point. This is going to be what drives their growth, if management's able to achieve their growth expectations, is 100 million paying subscribers in the next few years, in large part by working with these existing bundles. They've already done the marketing for them. They've already doing the marketing around the world, saying, hey, you want to watch TV? We have the best bundle. And part of our bundle is you have Curiosity Stream for factual content. It's super interesting. So let's keep going into this. So why does this business model get so attractive? So 2 parts. Let me start with this bottom one first. In late 2018, we signed our first multi-year, multi-million-dollar bundled agreement with a distributor in Singapore who is dropping a well-known network. So this goes back to the point we were just saying. So if you have these TV bundles around the world, they dropped a different network that was previously providing factual content in their bundle. They swapped it in for Curiosity Stream. So that sort of fits this narrative of like, hey, you want to shave some costs on your bundle? This might be the way to do it. Curiosity Stream, more affordable. In this construct, we offer to cable operators, direct broadcast satellite providers, and wireless companies a broad scope of rights, and they talk about the rights. And just as is with Disney Plus or HBO Max, it provides us a path to hundreds of millions of global paying subscribers. The reason why this really gets me excited thinking about this aspect is because you're taking a revenue source, and the revenue source is inherently becoming an advertising source as well. That's the part that makes this so beautiful, is like, yeah, you're undercutting the legacy, the bloated legacy providers to get in the bundles around the world for factual media content, and then you're effectively getting free advertising as these bundles are like, oh yeah, you want factual content? Here's CuriosityStream. Oh, you've never heard of CuriosityStream? You'll love it. Here it is. Like, feel free to check out this library. And you're like, wow, Earth 2, or wow, those killer dinosaurs. That looks really amazing. And so, you know, that's the appeal here, is you have a business model that has revenue, and then someone else is doing the advertising for you, or the revenue and advertising start, you know, sort of feeding off each other. Another way to look at it is like, here's another source of revenue that's very tied to advertising, where in January of 2019, we persuaded a corporation with 8,000 employees to buy an annual subscription to CuriosityStream for all their employees. We said, you're providing your employees with all kinds of benefits: coffee, snacks, gym memberships, parking. Why not provide the greatest gift of all, the gift of curiosity? Very, very cute. We're family friendly, engaging, and enriching, and every time one of your employee watches CuriosityStream, they will think positively of you, their employer. After that, another 40 companies elected to purchase subscriptions for all of their employees over 2019. This is another perfect example, like either working with the bundles or doing some sort of gift program with corporations. That's a way of getting share. Like, oh yeah, didn't I used to work at this company, and I love that perk of being able to watch content when in my downtime. That's really neat. And then before you know it, oh, I didn't know CuriosityStream was like the Netflix of factual content. That's awesome. So it's just a beautiful aspect of their business model. And it's not only a beautiful business model, they're also putting out some beautiful projections. And you could see, you know, and this is where I call out at the beginning, you know, effectively 10x growth potential. 2020, they said they're penciling out revenue of 39.5 million. They're expecting to do 393 million by 2025 in terms of revenue. You know, looking at, you know, very fast revenue growth, 10x over a few years, 80% growth in 2021, accelerating to 91% growth in 2022. Then it sort of peters out to 49 and 36. Now, you don't see the profit until, you know, until 2022, where you're still significantly unprofitable, largely because you're investing a lot in advertising and marketing, you know, sort of getting this business to scale, getting those subscribers. But it is worth calling out that they do have a very healthy gross margin, you know, around 60%. You know, so for each new dollar, 60 cents is this profit that they're going to use to cover, you know, whether or not it's their ad budget, you know, or you know, general and admin. So they can, you know, this has the potential to be really fat operating margins longer term, and you know, they're penciling out 22% operating margins by 2025. Maybe it's even more in the years ahead, you know. But this is worth thinking about. You know, when you see this range, it's worth thinking about when we're doing our own valuation, which I include later in this video. But it is worth calling out that you see their cash balance, 128. You know, it's going from 180 million, which assumes, you know, the deal goes through, then 128 million, then 94 million, then 65 million. So even though they turned a profit in 2022 and 2023, their ending cash balance is actually expected to continue to decline. Why is that? And I think that gets to the component earlier that I was talking about, which is that they're still going to have to be investing in building out their content library. That means a lot of cash upfront to be building out that library, so you have owned content versus being perpetually over the barrel with licensing it. So that's sort of what I'm expecting with this ending cash balance. But ultimately, you do get high enough profits that it will turn into real cash flow, and your cash balance will start increasing. There's only one big weird thing about their predictions that I don't understand. If anyone has comments about this, I'd love to hear it, which is that their sub numbers are really weird, because they talk about like how in 2018 we had 1 million paid subs, then we grew to 11 million. And then here it is, the forecast is for 32 million. And, you know, they've said several times, hey, we think we can get to 100 million plus. And that's what you see here. That's what you see here. But if you look at like the presentations or like the third quarter 2020 update, and here's the 1 million at the end of 2018 and 11 million in 2019. But if you look at third quarter 20, the total paying subscribers of approximately 13 million, up 108% year over year. These figures it doesn't strike me as right. Like 13 million, up 108% year over year. That would imply you were at like 5-6 million, the prior year. But the reality is you were already at 11 million, by the year end 2019. So like how these numbers just don't make sense. Something isn't jiving there. I'd love to hear either management clear that up or some just greater clarity there, because that part does make me a little concerned that it doesn't match up exactly, because like, wait a second, how are you growing super duper fast? And they're growing 120% plus revenue growth in 2020 if their sub count's only 13 million versus this 11 million. Like that doesn't quite make sense. So I'm not accusing management of anything, because look, they've clearly delivered, they've clearly built, John Hendricks has done an incredible job with Discovery, and I'm excited that he's doing this with a streaming platform, Curiosity Stream. These paid sub numbers just don't quite make sense. So any clarity, love to hear it. So thoughts on the valuation. Stock has run up quite a bit. It's at 20. It's effectively double what it was at the deal price of $10. You got to look at the fully diluted share count. It might be even more than this now, but by and large, you're looking around $1.3 billion valuation for the company. 18 million revenue, 20 million, 40 million guidance. That's based on this approximately, 39.5, 18 million here. And so 18 to 40, nearly 120. So then what's the 2021? This high side is largely based on management's guidance. You see 71 for 2021 and 394 for 2025, and that's the same thing I'm doing here. 394 for 2025 and 71 for 2021. And so you can see like that I'm using management's guidance for the high case, and then doing a more conservative take for the base and low side. So, implied growth in the next year, 70 to 80% based on management's guidance. What's the long-term margins? I'm penciling out 18 to 25%. If they're able to get 60% gross margins, they could probably get half pass-through as operating profit longer term. If they don't, it's, closer to 18. They themselves are penciling out 22% around in the next few years in terms of their operating profit, slap on a tax rate. And you could see where it's trading. It's not a cheap stock at all, trading at around 100 times. This is optimized earnings. This is what their optimized profits could be, based on, what you think their margins could look like in the years ahead. What are their margins at maturity? Well, what's the growth rate after this next year? So then the following 4 years. So I try to look at things over a 4, 5, 6 year time frame. So in this case, I'm looking at it over a 5-year time frame. So you have 2021, and then you have the following 4 years. So here, this 53.4, that's to tie exactly to, about to their revenue estimate. Then do different cuts. Here's the low side is 35% revenue growth. The other is 45% revenue growth. And then what's the range of multiples in the years out? And a lot of this multiple, I did a whole exclusive video for Journey subscribers, how I think about valuation. But if I had to boil it down to it, I would say it comes down to is how profitable is the business model, and what does the growth rate look like 5 years from now? Because if it's still super compelling, you could probably pencil out a very attractive earnings multiple, even based on margins that haven't been delivered yet. And so based on that, you see 20 times on the low side, maybe their growth rate's not exciting enough, or, maybe you see some competition come in. And on the high side, I'm putting 40%. So you can see over 100% upside over the next 5 years based on the current share price, but over 50% downside as well, even delivering on pretty exceptional growth, 35% annualized growth, 70% growth this next year. So a lot depends on what do you think that end valuation will be, what the sentiment will be. And keep in mind, this is my value proposition to you. I try to provide a framework for you to think about, these investments where, this is a tool. You can go to file, you click download, and then, play around with the assumptions yourself. So that way you could say, well, wait a second, I want to underwrite this where, I don't think I have that much downside. So you change around, what price you'd be willing to get at it, or what, I think Daniel's all wrong on what the end margins are. Maybe you think the end margins are really 25 to 30%, and that definitely changes the outcome. So that's something for you to think about, for you to pencil out. Overall, I think CuriosityStream is a very interesting company. Of course, it could go way higher or way lower than what I'm penciling out here. You have certainly recently gotten animal spirits that just pump things up, but you also, look, at some point people might get fearful or something like that, and sentiment might change. But it is like, look, this is an exceptional company. I think the management's really interesting. These are proven folks that deliver and build companies. So that's interesting to align oneself with that. It's a hyper growth company with the potential to 10x. You don't see a lot of companies where you could say, yeah, I am confident that they could do this, that they could potentially do a 10x in the next few years. The question is, how much of that is baked into the price already? Because a lot of this, Charlie Munger likes to call out how a lot of stock investing is sort of like horse betting, where everyone knows what a good horse looks like, so the odds change, the payoff changes based on the fact that everyone knows you have a good company. So that's part of the reason why I lay out this valuation sheet, is that everyone sort of knows, like, oh, this is a good company. The valuation's doubled in the last few months. So the risk reward, that payoff isn't as compelling, I'd argue. Just because everyone knows, and the question is this risk reward down over 50%, up over 100%? Is this over 5 years, mind you? Is that risk reward really compelling enough? And I'm not crazy sold on it. In the last few weeks, I've actually posted 2 potential multi-baggers exclusively for Journey subscribers. And, the first I thought had over 800 upside potential. It's already up pretty significantly, but still has several 100% upside potential. The second, potential multi-bagger, these are both companies I've bought personally for my portfolio. I think it has over 200% upside potential over several years. And then later this week, I'm actually going to post about, what I think are 2 more stocks that I think have better risk-reward profiles than CuriosityStream. Even though I think CuriosityStream is a super interesting company, I think there are other plays that have better risk reward personally. But to see all this type of content, the potential multi-baggers, or what I'm interested, go to unrivaledinvesting.com, click on Journey. You can see what I buy, what I sell, what I hold. I do monthly updates there, but I also do intermittent updates of like, hey, I actually made this a big percentage of my portfolio, then I'll update you. Each month, I try to do educational content for you to learn, how to think about finding these types of companies, how to value them. I have a full catalog of the exclusive content. I put a link below in the description of this video. You click on it, then you can see all the exclusive posts so you can know what you're getting into if you're interested. And the reality is, just finding one potential multi-bagger can change your personal life journey. So if you're interested in following my personal journey to try to find these potential multi-baggers, go to unrivaledinvesting.com. And if you enjoyed this video learning about CuriosityStream, CURI Stock, it is a very interesting company, growing super fast with lots of potential. Make sure you subscribe if you enjoyed this video. If you're already a subscriber, I really do appreciate that thumbs up. And thank you so much for watching.